Let's make up some time. Thanks for putting up with that. That's why I do my audio test every time. So if you've been with us before, you might have wondered why I do that so much. Now you know. All right, let's go. This is the San Diego County September market update. And really quickly here, I'll just bump myself there out of the way. Really quickly, I run Beer Home Team at eXp Realty. We've done more than $3 billion worth of sales in San Diego over the last 17 years. It's actually, we just turned 18. And that's landed us on the Wall Street Journal list of top 50 teams in the country. Inc. 5000, 4-time recipient. San Diego Business Journal has named us the top, one of the top places to work. San Diego Business Journal has also named us the top producing team in San Diego County. Been an expert guest on NBC, ABC, Fox. Look, I just say all that to share that the information that I'm going to share with you, the analysis is coming from experience. It's not, I'm not just leaning on the license I might have gotten a year or two ago. This is from a lot of experience. So that's my kind of professional bio. The personal bio, the more important bio is what you see right here. This is my wife, Liat, on the top left, my 3 kids, that girl and the little boy there. They're twins, Leah and Ellie, and then my 9-year-old boy, who he's just awesome. I think of him as my best friend. I don't know if that's good parenting or not, but in any case, it's just great. And then up on the top right, you actually see 2 of our leaders, 2 of the really, really key people that make the Beer Home Team go. And that's Mary Davis right there, marketing director, and Laura, who runs operations in our company. So off and running. Now you see a little bit about us. So I'm going to start here where I'm going to share some data that I kind of share every time. So if you've been on many of these in the past, you know that there's some things that I do every time just for continuity. And then there are always unique elements following this. You're going to get some really unique elements that are just, it's time that we discuss them. Okay. And again, the goal of this, which I should have presented earlier, it's that there's a lot of information out there, but a lot of misinformation, a lot of slanted information, a lot of politically driven information. And it's just, this is the no agenda, like, here's what it is. I don't care if it's good. I don't care if it's bad. If it is, then I'm going to report it. And then it's yours to have the information. You can make with it what you want. New listings in San Diego, down 28% in August of 2023 versus August of 2022. So new listings, okay, less of them continue to hit the marketplace. Now you'll notice in the graph, the bar chart, that it was starting to rise a little bit, which was nice, but that's always to be expected through the summer months. And now that we're kind of on that back end of summer, if you've ever heard me say in the past, the lowest inventory months are always into the cold months of the year. And that I always have said that inventory will peak in around, about August, September or so. And then you'll have a drop all the way through February, and then you'll have a rise. And that's kind of that pattern that you see, even if you kind of just look back here at the previous years on that bar chart. So I would expect that inventory levels overall are going to start to drop and will continue to drop probably through February. Pending sales down 23%. So even though I just said that I'll expect that to happen, that it's cyclical, keep in mind, this is comparing August of this year to August of last year. So there is a drop in new listings, which therefore is in pending sales, which therefore is also in closed sales at 19.5% less closed sales for that month. Because of that, because there's less available. So the closed sales, this is where the news will get funky on you. They might report something like, hey, sales down, 19.5%. Well, they didn't report that inventory, right? New listings hitting the market down 28%. So of course, when you have that much fewer listings hitting the market, you're probably going to get fewer sales, but it's so inventory driven that pricing actually up 10.6% from a year ago on a median basis, and on an average basis up 13.2%. So significant. By the way, before I even move on, I want to make sure that you make use of the chat. And if there's any questions that you want answered, if there's any interpretation, if there's any just clarification of any kind, make sure you go to the chat. And if I don't answer it right here live, I do make sure to circle back to 100% of anything that comes through the chat, and I will come back and answer it personally. So with that, you start to see that the days on market have dropped. The average days on market down to 24 days on market from 27 a year ago. So property moving very quickly because there's not too much out there, and affordability has dropped 21% as well. Now, homes for sale right now, current inventory levels, there's 4,662 homes on the market. That includes, of course, condos, it includes townhomes, it includes everything, down 4.8%. From a year ago. In month supply, now you have that up actually, interestingly enough, at 2.4 months of supply. What's interesting there is that's another area where the news will be kind of abusive in that they might report like, hey, like market crash coming, inventory, month supply up 33%. Yeah, it's at 2.4 months though. It's at 2.4 months. So when you look at, the widely accepted definition of a balanced market, it's 6 months inventory, anywhere from 4 to 6 months. We're at 2.4. All right. This is just, again, more continuity from what we always present. So right now, average, you could expect your loan rate on just a vanilla 30-year, right? You didn't pay any points, just totally vanilla mortgage rate, about 7.125%, which on a $720,000 loan, which would be for a $900,000 home, about $4,851. Now, that same payment when rates were at 3.5% would have been 33, which means that today it's $1,618 more expensive to make that payment. Having said that, think about what's happened to the equity. So from them to now, you would be losing, right, like 30 grand or what have you a year in terms of cash flow. But you are more than making it up on the equity side if you were an owner throughout all that. So just something to keep in mind. A lot of people are out there celebrating the $100 or $200 or $300 a month they're saving on their rent payment versus their mortgage payment, and they're completely ignoring the many thousands a month that they're losing on the equity that they're not gaining, not to mention the tax savings. So I want to give you a quick little back of the napkin look at the market, because right now that we're talking interest rates, that is, of course, the narrative around everything. It's interest rates, right? You yourself, you might be waiting for interest rates to drop. Someone you know is waiting for interest rates to drop. That's the narrative. But there we go. I turn my microphone off for a moment. But let me just be clear. Let's make sure that that you really look at what's happening in real life. Okay. And I wanted to draw this out for you. Let me see if I can get this little whiteboard thing to work. But I don't think I can. So let me see. For some reason, it's just, this thing's a mess. All right. I'll just explain it. Right now, there are few homes for sale, little inventory. Okay. So imagine there's this home and just these two little fingers. Those are homes. The two homes that fit your criteria, which anyone with your criteria, those are the two homes that fit theirs. What's happening in the market is there's still this buyer, that one, and this one, right? There's still more 3, 4, 5 buyers for those two homes. There's more buyers than homes. And of course, we've been watching these prices rise. Having said that, interest rates are keeping a lot of people out of the marketplace. And so there's so many people. And as active real estate agents that are working with hundreds of people every year, we could tell you the amount of people waiting on the sidelines for interest rates to drop is gigantic. So I think of it as there's this interest rate kind of barrier, interest rate force field that's keeping out all of the demand, all the people that want to buy once the interest rates drop. So outside of there, while inside there's 3 or 4 or 5 buyers for those two homes, outside there's dozens and dozens and dozens and probably many hundreds of buyers for those two homes. So outside there's just right. If I was drawing on that whiteboard, I'd be drawing 100 little dots outside of it. And I want you to think about, and the conclusion is yours to make, when interest rates drop, which is what so many are waiting for. And that force field, keeping all those people on the outside, and there's only the 2 or 3 or 4 people you're competing with right now on the inside, when that barrier goes away because interest rates do indeed drop, and now all those people on the outside are on the inside fighting for homes, what do you suppose is going to happen to pricing? And if you have the same conclusion that I do believe that when that happens, well, we'd have to prove Econ 101 to be wrong if we think that much more demand would not prop prices up further. So just beware of that. Now, look, if the interest rates are making it so it's unaffordable to you that you literally cannot buy, you can't get from the lifestyle you have to the one you want, then of course you don't buy. Do not do what would not be economically reasonable for you to do. Having said that, if you have the ability, but you're choosing not to because you don't like the rate, what's going to happen is once that goes away, your competition is going to exponentially grow. And on the inside right now, while that force field exists, on the inside, those 2, 3, or 4 people fighting for those two homes who are going to get the home with less competition, still competition, by the way, but just less than what will be later, they'll just refinance when those rates drop. And of course, you already knew that. But I want you to think of it in terms of this change, just kind of all that pent up demand that will be coming in once those interest rates change. So that's kind of the back of the napkin look at it. I want to go through a couple things. Why will the market crash? Why may it crash? And why might it not crash? This is a conversation that we're just getting asked a lot. Hey, Dan, when and why? And do you think it will crash? I think it might, right? Everyone has their guess. Look, I'm just going to supply you with reasons why it may, reasons why it won't. And like I said, so this is the non-slanted, just you get information, then you can decide. You can make a decision around it. Why would it maybe crash? Well, one is if the Fed overdoes it. Overdoes what? Overdoes their interest rate hikes. The Fed is in many cases, like if you actually look at what's happening, have you noticed that a good jobs report actually makes interest rates rise and the stock market drop? So what's happening is when there's a strong jobs report, which is exactly contrary to what the Fed is trying to achieve through its interest rate hikes that have been going on now for a long time. When there's a strong jobs report, it tells the Fed, hey, these businesses are hiring because there's a lot of demand. And if there's a lot of demand, then there's upward pressure on pricing, not down, and we're trying to achieve down. So the signal that the Fed will take, that there's actually, and that the market will take, that there's actually finally that inflation's getting to where they want, is if we have a poor jobs report. So it's counterintuitive because you might be watching, you're right, on Bloomberg or CNBC, wherever you get your stock market news, and just why every time there's a strong jobs report does the market drop? Well, the reason why is because the market knows the Fed will raise the rates to try to force a poor jobs report. So if the Fed overdoes it and they don't get that soft landing that they're talking about, then if that happens, you could end up with so much job loss that now you have a problem, right? So cooling jobs market and reinflation of the housing bubble, there is already a cooling jobs market, but it's still hotter than they want. So they continue to raise these rates. And if they go past some kind of, everyone's trying to figure out where's that line of no return where we absolutely crush the entire system, and they're trying to balance around that. If they miss the balance, by the way, foreclosure rates, it's a perfect typo. Foreclosure rates are ticking up right now in New York, Philadelphia, and Chicago, just FYI. They are stable here in San Diego, totally stable. But the summary, if that you're going to argue for some kind of crash, then you have to be able to argue that we're going to see massive job loss as a nation. You have to be able to argue that, because it's really the thing that if we suddenly had a ton of unemployed people that couldn't pay the mortgage, then yes, now you have some kind of, you have issues in the housing market, no question about it. Right now, that's not the case. While the job market is cooling, it is still not nearly as cool as much as the Fed would want, which continues to have them raising rates. So that battle, that balance, absolutely something you need to be watching. Now, on the other side of it, why the markets won't crash. Well, number one is that inventory right now is dismally low, terribly low. And so no supply creates support for pricing. So that is a key reason why rate markets would not crash. Number two is that higher interest rates create zero incentive for meaningful inventory growth. As long as we have these higher interest rates, there is no incentive for anyone that does not have to move to make a move. So right now, the people that are moving, for the most part, are people that are having some kind of big life change, right? There's a marriage, there's a divorce, there's too many kids in the home, there's a relocation, there's all those sorts of life events. We talk about them in my circle as the D's. Right, there's a series of D's: diapers, meaning you've had kids; the D for divorce, D for destitution. Right, you've gone broke, etc. So that's outside of those sorts of events. There's not a lot of incentive for it. I do think, though, that if you really pay attention to that, discussion we had earlier about that interest rate force field, keeping all that demand outside, and what happens when that goes away, and how much demand's going to rush into the marketplace, that's pretty significant. And also think about this. If the market actually did go into any kind of fall, interest rates would all fall, which would then let those people back in. So again, you would need huge job loss to counteract that. And I want to just illustrate the point here really quickly. In Solana Beach, right here in San Diego County, and Solana Beach is one of the only 3 submarkets in San Diego. It's one of only 3 submarkets, not one of. It is one of. It's one of only 3 submarkets in San Diego where inventory is up. And so in Solana Beach, prices are actually down from a year ago. But that's one of 3 submarkets across the whole county. My point being is that to find negative pricing, we had to also find the market in San Diego where inventory dropped, or excuse me, where inventory rised. So with more inventory, with more supply, okay, so that's the thing to watch right there. Now, this one's huge, and I wanted to give this its own slide, okay? Resumption of student loan payments. This is kind of back to the, why there could be trouble in the future. This is something to watch. As you might know, the Biden administration, and by the way, I'll talk about what politicians are doing, but I'm just giving you facts, okay? So it's don't get hung up on it. Which way is he? No, I'm no way. I'm the truth way in terms of just reporting to you what's happening. The Biden administration paused student loan payments, millions of them. And in October, they resume. So here's just a question that I ask you, and then you decide what the conclusion of this is. What do human beings do when suddenly they have less expenses? What do human beings do when they find an extra $100 in their pocket at the end of the month? What do human beings do when they find an extra $1,000 at the end of the month? What they do is they expand their lifestyle. So the danger here, and the real thing for you to watch, is when those payments were paused, how many people increased lifestyle with short-term thinking, and as soon as those payments resume, whoops, I can't pay the mortgage. That's the thing to watch right now. That's coming in October, and definitely you need to have a pretty sharp eye on this. We will have a sharp eye on this. We'll report back to you what we see happening. But that is a big deal right there. Beware of politics too, just talking politics. So RFK Jr., and by the way, this does not mean beware of RFK Jr. This has nothing to do with vote for him, don't vote for him. That's not it. That was just a reminder for me to know what to talk about with you. Beware. He is promoting an idea that he's going to use once he's president. And it sounds great. He says, you elect me for president, I am going to make it so that every American, every working class American, all of us can go and get a 3% mortgage. And the way I'm going to do that is that just like if you had a rich uncle who would co-sign on a loan for you and get the rate down, buy it down, etc., we're going to have Uncle Sam act as that rich uncle for you, back the mortgages, pay down the rate, and you're going to have a 3% rate. Awesome. The sentiment behind it, great. The care for the American people behind it, beautiful. There's a big problem. Huge problem. What do you think people will do if suddenly their buying power is an extra $1,000 or $2,000 a month? What do you think they would do? Well, going back to that one of the first slides I shared with you today, in that example, what do you think people would do if their buying power was an extra $1,600 a month? Do you think they'll just still buy the same price home they were going to buy earlier? Or do you think they might now buy even a more expensive home? This program and programs like it, programs like pausing the student loans, for example, when we manipulate the marketplace, go back all the way to all the stimulus that created the mess we're in. When we manipulate the marketplace, we rarely get the outcome that we're actually looking for in the long term. We get exactly what we're looking for in the short term, normally. So just beware that my view, and I will share my view is that with that will not accomplish a thing in terms of affordability, because when you give everyone an extra $1,500, $1,600 a month of buying power, all that happens is everyone's now just making higher and stronger bids, which is pushing pricing up, completely counter to what the intent of the program would be. And the intent is great, but the result would be complete opposite of it, and the taxpayer would be paying for that pretty dearly. So what will the Fed do next? Next up, this is a quick look here at what Wall Street is predicting the Fed will do. Currently, the Fed funds rate. Okay, so when we talk about the Fed raising rates, they don't raise mortgage rates. They raise what the Fed, what's called the Fed funds rate, and that's the rate at which then banks borrow at, then they'll lend to you and I. So currently, it's at 525 to 550 basis points. Basis points is just a fancy way mortgage people talk about. You could just think of it as 5.25% to 5.5%. That's where it's at now. On September 20th, there will be, so how many days from, right? It's 4 days from the recording of this. You might be watching this on a recording after the fact, but the Wall Street is predicting 96% of Wall Street is predicting that no change will happen, none. And what's interesting is that when you go out and take a look at the next meeting on November 1st, the Wall Street's actually at that point predicting that, you know what, they're going to take a break right now in September, but enough of us now, 34% think that they'll do another quarter point hike at that time. And then for the following, Wall Street, for the most part, does believe, right? See that 550 to 575 is what that predicts on the November. On the December, there's the marketplace is guessing that it'll either top out there at 550 to 575, or it will have topped out at 525 to 550. So overall, the market, that Wall Street is predicting that we're either at peak interest rates that the Fed will go to, or we have one more. And if we have one more, they're predicting it will not happen this month in September, but that it will happen the following month, if not the following. So it's just kind of an interesting thing. We want to watch that. The thing that will always drive it is CPI. CPI came out just a couple of days ago, hotter than they wanted. CPI being the consumer price index, gives them a look at inflation. Came out a little hotter than they wanted. And so it's just something to keep a very, very close eye on. And mortgage rates ultimately, remember, will follow inflation. Inflation's up, mortgage rates will be up. And as soon as inflation comes down, you'll see mortgage rates follow right behind it. So that's a quick look at what's happening there. And I just want to end with this. And this is just from me and just something I've been sharing with people as I've now been through several cycles, right? I've been doing this a long time. And beware of the "it will never be the same again" fallacy. Look at oil as an example. It went to zero. It went to negative, just a short time ago. Oil will never be up there anymore. It will never be in the, it won't even be over $50 a barrel ever again because of electric and because of solar and because of, all these things. Not true. It returned to the 80s. The, pricing is up. We tend to think it'll be up forever. Pricing's down. We tend to think it'll be down forever. We get a pandemic and we can't go outside and we're wearing masks. We think we're going to have to do that forever. That is a huge fallacy that humans continuously fall into. Beware of it will never be the same again. So find right now what in the housing market, what in the economy are you saying to yourself, you know what? Here's all the reasons why pricing will always be this way, or that interest rates will be high forever moving forward, or that we'll never go back to what they were. And just be careful that you're not playing into the "it will never be the same again" fallacy. That is my update today. You can get your updated home value, your personalized updated home value using that QR code. You can also go to soldbydanbeer.com. Right on soldbydanbeer.com, you're going to see a place to just insert your address, and you're going to get, through very sophisticated technology without even having to talk to an agent, you are going to get a personalized value that then will update itself over the course of time. And so that's something that a lot of people that come across our world, they're all working with it. And the comments behind it just provides a really great amount of detail, great clarity. So you could use the QR code. You could also go to soldbydanbeer.com. If there's anything we can do to help make real estate easy for you, that's our job. And in fact, it's the primary reason why the San Diego Business Journal has recognized us, why the Inc. 5000 has us 4 times on their list, is that we want to make this easy. And most importantly, while most people don't get what they want, all of what they deserve, more importantly, from their home sale or purchase, we developed a system that makes it so that we have to perform or we don't get paid. And it's all part of the industry's most outrageous guarantee that we've put together. And it's the intent behind it is that you should have a risk-free and easy experience, but with all the upside, because it's through real estate that people's net worth genuinely moves. Unless you have some gigantic, liquidity event, or you sell a company, for most of us, it's how our real estate performs. You want to get the most out of it. And so go to Sold by Dan Beer, get that update, and we'll look forward to seeing you on the next one. Make sure you drop anything in the chat that you need questions on, clarity, any of it. I personally will answer every single one of them. Until next time.